The month your car loan clears, the month you make that final payment and feel like you finally won something. That is the month a department inside your bank marks your account as high priority reactivation. Not because they care about your financial future, because your credit profile just peaked. Your debt to income ratio just improved. And to the scoring system that runs your financial life, a person who just paid off a loan is not a success story. They are the most valuable prospect in the building. Here is what happens on the day you pay off your car loan, depending on which side of the table you're sitting on. Your side of the table, relief, a sense of achievement. Maybe you tell someone, maybe you look at your bank app and feel, for the first time in years, like your money is actually yours. You start thinking about what you'll do with the extra $400 a month. The bank's side of the table. An automated flag triggers in their CRM system. Your account status changes. A risk score is recalculated. You are no longer classified as an existing borrower. You are now classified as a warm, lapsed customer with a recently improved credit profile. The same event, two completely different realities. And here is the asymmetry that almost no one in personal finance talks about directly. The bank has spent decades and billions of dollars studying the behavioral patterns of people who just paid off loans. They know your psychology better than you do. They know that the emotional high of debt freedom lasts approximately 90 days before lifestyle expansion fills the gap. They are not waiting for you to come back. They are engineering the conditions that make coming back feels like your own idea. Let me show you exactly how the reactivation pipeline works, because most people imagine the bank as a passive institution, sitting behind a desk, waiting for you to walk in and ask for a loan. That model is 40 years out of date. Modern lending institutions run something called a propensity to borrow model. It is a real-time scoring system that ingests hundreds of data points. Your payment history, your credit utilization changes, your income signals, even your browsing behavior through affiliated apps, and spits out a single number, the probability that you will take on new debt in the next 90 days. When you pay off your car loan, every single one of those variables improves simultaneously. Your score spikes, your propensity rating climbs, and the moment it crosses a threshold you have never been shown and cannot access, your account moves into what they internally call the active outreach queue. The phone call you get offering a home equity line, the pre-approved personal loan offer that arrives in your mailbox, the 0% APR credit card that shows up in your email. These are not coincidences. They are outputs of a system that has been tracking you, scoring you, and waiting for exactly this moment. The three weapons, how reactivation gets you. So which product does the outreach queue pitch you first? The answer depends on your specific profile, but the sequencing follows a pattern that is remarkably consistent across lenders, and it is built entirely around behavioral psychology, not financial logic. Weapon 1, the upgrade offer. Your car is paid off, but it is now 3 to 4 years old. The first outreach is almost always framed around your car, not debt. It is an invitation to upgrade, to get the newer model, to reward yourself for being financially responsible. The loan structure is almost identical to the one you just escaped. The psychological framing is completely different. This time it feels earned. Weapon 2, the lifestyle expansion loan. If you don't take the car upgrade, the second wave hits your home. Home improvement loan, kitchen renovation. Your equity is working for you. The framing shifts from reward to investment, making debt feel like a financial strategy rather than a liability. Weapon 3, the silent creep. Credit limit increases on existing cards. New card offers with better rewards. Buy now, pay later integration on apps you already use. These don't feel like debt offers. They feel like benefits. They are not benefits. They are access to a larger debt ceiling, delivered in the language of perks. The neuroscience of debt re-entry. Why you accept. Now let's answer the deeper question. Not just how banks target you, but why the targeting works. Because the behavioral science behind debt re-entry is genuinely one of the most well-researched and least discussed areas in consumer finance. There is a concept in behavioral economics called debt normalization. When you carry a car payment for 4 years, your brain stops experiencing the payment as a loss. It becomes baseline. It becomes the normal cost of having a car. The $400 monthly outflow becomes invisible, psychologically categorized as a fixed cost of existence, not a financial choice. When the loan ends, two things happen simultaneously. First, the $400 frees up, but your brain doesn't reclassify it as available wealth. It still registers as the car payment category. Your spending architecture has a $400 shaped hole in it. Second, the absence of the payment creates what researchers call payment relief euphoria, a short-term emotional high that lowers your financial guard and increases your receptivity to new offers. Banks know this window opens, they know it closes, and they know that the person most likely to take on a new loan is not a person who is struggling financially. It is a person who just finished paying off their last one, while still operating under the behavioral pattern that made monthly. Here is the mechanism, and this is the part of the video that tends to make people uncomfortable. Not because it's complicated, but because once you see it, you realize you've lived through it and didn't recognize it while it was happening. Banks and lenders use what's called a contact cadence protocol. The first outreach hits within 7 to 14 days of the final loan payment. This is deliberate. You are still inside the euphoria window. Your financial guard is at its lowest point in years. The offer is framed around congratulations. You've been a valued customer. You've earned this. Emotional language, not financial language. The second contact comes at day 45. By this point, you've started to mentally allocate the freed up payment. Maybe toward savings, maybe toward a vacation. Now the offer now shifts to practicality. Build your future. Invest in your home. It meets you where your mind already went. The third contact, if you haven't responded, comes at day 75 to 90. This one uses scarcity framing. Pre-approval expires. Rate lock ending. Limited offer. They know the euphoria window is closing. This is their last move before you stabilize into a new financial pattern that's harder to disrupt. 3 contacts, 3 psychological frames, timed with precision. Most people dismiss the first as noise, half consider the second, and almost take the third because it feels urgent. Stop here for a moment. We've covered the reactivation pipeline. We've covered the 3 weapons, we've covered the contact cadence and the euphoria window. So if you walked away now, you'd know more about how lenders target post-payoff borrowers than 95% of personal finance content has ever told you. But here's what we haven't covered yet. And this is the part that changes the actual financial outcome. We haven't talked about what institutional level borrowers do differently in this window. The people who understand this system from the inside, the ones who have worked in banking, in lending, and institutional credit, they don't just avoid the reactivation trap. They exploit the same window the bank is trying to exploit. The 90-day post-payoff window is not just the bank's best opportunity. It is also your single best annual opportunity to restructure your financial position. The freed cash flow, the improved credit profile, the reduced debt-to-income ratio. These are not just attractive to lenders. They are attractive to any asset that requires leverage, at better terms than you will have at any other point until the next payoff. The second half of this video is about that, not just how to avoid the trap, but how to use the exact same window the bank is using, before they can use it on you. Here's what someone who understands credit architecture does in the 90 days after a major loan payoff, and why it produces completely different outcomes from what most people do. First, they do not treat the freed cash flow as discretionary income. They treat it as redeployable leverage. A $400 monthly payment that is now free is not $400 in spending power. It is the monthly service capacity for a new obligation. And the question is not, what do I want to buy, but what asset can this now service? A $400 monthly payment can service approximately $25,000 to $35,000 in debt at current rates, depending on the term. The difference between pointing that capacity at a car upgrade, a depreciating asset, versus pointing it at a rental property down payment fund, an index position, or a business asset is not a small difference. Compounded over 10 years, it is the difference between having a newer car and having an asset that outperformed that car's total cost. Second, they use the credit profile peak strategically. Your credit score at the moment of payoff is likely the highest it has been in years. This is not the moment to rest on that score. This is the moment to apply for the credit instrument you actually want: a business line of credit, a low-rate personal facility, a mortgage pre-approval. Because the terms available to you right now will not be available to you once you take on new consumer debt and your utilization climbs again. The window is real. The question is who uses it first, you or the bank? The post-payoff decision framework: 4 moves in 90 days. Here is the specific framework: 4 moves, 90-day window, in the order that matters. Move 1, day 1 to 7. Freeze before you allocate. Before you do anything with the freed cash flow, implement a 30-day freeze. The money goes into a dedicated account, separate from your spending account, separate from your emergency fund, and it sits there for 30 days while you run the analysis. No car upgrade, and no renovation, no new card. The freeze is not financial passivity. It is the most active financial decision you can make in the first week, because it keeps every option open while your emotional state normalizes. Move 2, day 7 to 30. Run your credit position audit. During the freeze period, pull your full credit picture. Not just your score, your full report, your debt-to-income ratio, your available credit, your utilization rate. This is your strongest financial snapshot of the year, possibly the strongest of the decade. You need to know what it says before you do anything that changes it. Move 3, day 30 to 60. Apply for the instrument you actually want. Using your peak credit profile, apply for the credit instrument that serves your actual financial strategy, not the one the bank is offering. If your strategy requires a business line of credit, apply now. If it requires a mortgage pre-approval, apply now. If it requires nothing, then your credit profile sits at peak for months, which means any future application will be at better terms than any future point after new debt enters the picture. Move 4, day 60 to 90. Deploy the freed cash flow structurally. After the credit audit and the strategic application are complete, now you decide where the $400 goes, not before. At this point, the question has changed from "what do I want" to "what does my financial architecture need?" Those are different questions. They produce different answers. And the gap between those two answers is the gap between the person who uses the window and the person the bank uses the window on. Let's close the 2 questions we opened at the beginning. What is the reactivation mechanism? It is a real-time behavioral scoring system paired with a 3-phase contact cadence, timed to the 90-day post-payoff euphoria window, designed to convert the emotional high of debt freedom into the entry point of a new debt cycle, using the very financial improvement your payoff created as the reason to lend to you again. Why does paying off debt make you more valuable to lenders, not less? Because a paid-off borrower has proven payment capacity, improved credit metrics, a behavioral pattern of accepting monthly payments as normal, and a psychological state of maximum receptivity. You are not a risk. You are the ideal candidate, and the system was never designed to let that candidate stay free for long. The takeaway is not to fear debt. It is to understand that the financial system is not neutral infrastructure. It is an active participant with a positioning strategy, and that strategy relies on you not knowing the timeline, the psychology, or the framework that defeats it. You now know all 3. Your car is paid off. The bank has a plan. You just built a better one. Forward macro question. 1 loop deliberately left open. 1 question I want to leave genuinely open. Not as a teaser, but because the answer is more complicated than any single video can carry. The reactivation system we've described, the scoring, the cadence, the behavioral targeting, it was built for consumer debt, car loans, personal loans, credit cards. The infrastructure existed before most people had smartphones, but the same architecture now operates across a much wider surface. Buy now, pay later platforms, subscription services with financing embedded, employer-linked credit products, financial wellness apps that track your spending and route that data to affiliated lenders. The question worth sitting with is this: if the original reactivation system was built around 1 payoff event, the end of a single loan, what does the modern version look like when the behavioral tracking is continuous? The contact points are embedded in every app you use daily, and there is no payoff event that creates a clear window of freedom. Is there still a window, or has the window been replaced by something more permanent? That question doesn't have a clean answer yet. But the people building the next version of this system already know what they want the answer to be.